You know, right in the heart of Colombo, there's an icon, a real king of commerce from back in the day. But even the shiniest crowns can tarnish, right? So today, we're going to dig in and find out if its owner, CT Land Development, is actually polishing that crown or just weighing it down with a whole lot of debt.
So who are we? We're Optivest. And our whole mission, really, is to slice right through all the corporate hype and the speculative noise you hear out there. We're here to give you, the rational investor in Sri Lanka, clear, data-driven analysis. We stick to the numbers, period, not the stories companies want you to believe.
Okay, before we dive in, we have to get the crucial disclaimer out of the way. This is super important. Everything we're about to discuss is for educational purposes only. This is not investment advice. All of our analysis comes from information that's publicly available. Our goal is just to arm you with knowledge.
All right, so today we're putting CT Land Development, you probably know them as CTLD, under our forensic microscope. And we're zooming in on their flagship asset, their crown jewel, the one and only Majestic City. I mean, that name alone probably brings back a ton of memories for a lot of you.
Now, if you look at how the company talks about itself, they really lean into that legacy. They're constantly painting this picture of a cherished icon and a premier destination. And why? Well, they're trying to tap into that emotional connection, that nostalgia we all might have for the place. That's the public story they're selling.
But here's the thing. That brings us to the real question, the one that actually matters for investors. Does legacy pay the bills? I mean, nostalgia is a powerful feeling, for sure, but it's not going to pay off a loan or boost the bottom line. So it's time to push all that aside and look at the cold, hard facts.
Okay, so here's how we're going to break this all down. Our investigation is split into 5 key parts. First, we'll follow the money trail. Then, we're going to size up the new competition. After that, we'll dig into this massive 2 billion rupee bet the company is making. Then comes the verdict with our optimized scorecard. And finally, we'll wrap up with what this all means for you. All right, let's get right into the evidence. Part 1, following the money. We need to look at the numbers to see what was really going on at CT Land Development before they decided to make this huge move.
So if you look at their revenue right before this big renovation project, you do see a little bit of growth. It went from about 467 million rupees up to 524 million. But, and this is the key question you have to ask yourself, was that enough? In a market that was changing so incredibly fast, is that kind of slow, single-digit growth a sign of a healthy company? Or was it actually a red flag, a sign of stagnation that basically forced their hand?
And boom, here's the immediate price they paid. The latest quarterly report shows a loss of over 145 million rupees in just 9 months. That's what happens when you start tearing up your main source of income. You're literally shutting off the cash tap right at the moment you need it the most.
Now, this financial pressure didn't just happen in a vacuum. You have to understand the bigger picture here. CTLD was facing a storm of new threats that had been building up for years. This timeline really tells the story, doesn't it? For decades, after it was built back in '91, Majestic City was the king of the hill, no question. But then in 2018, Merino Mall pops up basically right next door. And then in the 2020s, you get this 1-2 punch of e-commerce exploding and a whole new generation of shoppers who just want different things. The entire game had changed right from under them.
And when you put them side by side, it's like night and day. Reports were pointing out that the old Majestic City barely had anywhere for people to just sit and hang out. Meanwhile, Merino Mall opens with this huge 10-outlet food court with a sea view. While MC felt, well, dated, Merino offered state-of-the-art entertainment. We're talking 9D cinema, VR games. It was clear the new competition wasn't just building another mall, they were playing a totally different sport.
And it wasn't just the buildings that changed, the shoppers did too. Think about it, especially that younger crowd, the 18 to 30 group. They aren't just looking for a place to buy stuff anymore. They want a place to hang out, a social hub, an attractive space. They want an experience. And if they don't get it, well, their phone is right there and online shopping is just a tap away.
So you've got flat revenues and competition heating up like crazy. Management finally makes a move. But here's the 2 billion rupee question. Was this a stroke of genius, or was it just a desperate gamble?
Just let that number sink in for a second. 2 billion rupees. That's the size of the bet they're making. And get this, it's not just some ordinary loan. It's a mortgage secured over the Majestic City property itself. To put it bluntly, they've pawned their crown jewel to fund this renovation. And this is the question every single investor needs to be asking. Why now?
Why wait until a direct competitor was already established in stealing customers, until your own financials were already under pressure? A proactive management team anticipates change. A reactive one gets backed into a corner. And all the evidence here suggests this was a move born out of necessity, not foresight.
Okay, so we've looked at the money, we've looked at the competition, and we've looked at management's big bet. Now it's time to bring it all together. It's time for the verdict, the Optivest scorecard.
Let's start with profitability. The score here is frankly extremely low. You have years of stagnant revenue, and then you follow that up with a massive, self-inflicted loss from the renovation. We can't give many points for that. Then we have financial health. This is just as concerning. When you take on a 2 billion rupee debt, you fundamentally change the risk profile of your company. The pressure on their balance sheet is just immense now.
Next up, management quality. Again, a poor score. The strategy was clearly reactive, a delayed response after years of watching the market shift without making a decisive move. And as for future growth, it's a binary bet. The company has pushed all its chips into the middle of the table. Their entire future is now pegged to the success of this one single high-stakes project. There is no plan B.
And that brings us to our final verdict, an overall Optivest score of just 3 out of 10. Let's be very clear. CT Land Development is no longer a stable legacy asset. It is now a high-risk turnaround play with immense pressure and significant challenges ahead.
So, what does all of this mean for you, the rational investor? Well, this case study gives us a powerful framework for protecting your capital. Think of this as your investor shield.
Here are 4 things to always keep in mind. 1. Look beyond the famous brand name. An iconic legacy doesn't guarantee future profits. 2. Scrutinize the debt. Ask how on earth it will be paid back. 3. Watch the competition. Ask if the changes are truly enough to catch up. And finally, number 4. Always question the timing of big strategic moves. It tells you everything you need to know about the quality of the management.
So, we'll leave you with this final thought. CT Land Development has rolled the dice. But is this the beginning of a brilliant rebirth for an old icon? Or is it a final, fatal gamble fueled by debt? Only time will tell. But you can be sure that the numbers will tell the real story. And we'll be watching.